Good morning, guys. So we have packet A here, and we're going to go ahead and just start rolling through here. Some of this, maybe a little bit refresher from what we covered the Thursday before we let off for spring break. So just bear with me. So sample A, what we are looking at here are pay stubs. So when you start working, you are going to start receiving these. Most likely, when you first start off, it's chances are going to be a paper pay stub. Some companies have moved to electronic pay stubs. Um, right, so if we just sample A and sample B are both pay stubs. So let's take a look at this so you know when you get these what each different part means. Okay. So we start off here, company name. This is going to be the company that you work for, okay, with their name, address, zip code, all that stuff. Then your name will show up here under where it says sample name, under employee name. In addition, right here will be your social security number, X'd out like that, only showing the last four digits. Employee ID, if your employer has that. Check number. This is just for records for the employer to keep track of their checks. Pay period. This is going to show how are you paid? Are you paid every week? Are you paid every 2 weeks? Or bi-monthly on the 15th or the first of the month, 15th of the month, or at the end of the month. Right? So for this, and then the pay date. Okay. For this individual, it looks like they are getting paid weekly, October 31st to November 6th, right? So they're going to get paid weekly. So let's take a look at this individual and how much they made during this week. Okay, gross wages. So they're hourly, right? So you can tell that they're hourly here. And over this week, they worked 50 hours a week with no overtime. But oh, sorry, that's the rate. They get paid $50 an hour. They paid $50 an hour. Here they worked 50 hours a week with no overtime. So that meant 50 times 50 is $2,500. Now this $2,500 is their gross pay. It's when you get yours, it's going to show you your gross pay without taking into consideration the taxes that are taken out. So $2,500 is not going to be deposited into his checking account. Right? That's a no checking. It's a no. Right? We have to take out different things first. So let's take a look at what is being taken out and what will ultimately get pushed into his checking account if he has direct deposit, which y'all should get when y'all start working. Sign up for direct deposit. Open a checking and savings account if you don't have one already. So the first things listed here are FICA, payroll taxes. These are the payroll taxes. Payroll. Okay. And FICA Med Tax, it stands for Medicare. FICA Social Security Tax, that stands, or SS Tax, that stands for Social Security. So just in terms of what's going on right now in the world, one of the things the administration has floated the idea of doing because chances are we are going to be in a recession, or if we're not already in one because of the virus. So one of the things the administration has done or it has floated out the idea in order to get the economy back up and going is having a payroll tax holiday, postponing payroll taxes. This isn't anything new. Other administrations have done it, both the George W. Bush administration after 9/11 and in that dot-com recession, they did a payroll tax holiday. And then President Obama, during the Great Recession, he also did a payroll tax holiday. So this is nothing new. and they're floating out the idea and the best way. What's the best way to do it? But if they did a payroll tax holiday and it's just every payroll, they don't have to pay these taxes, that would save this person about 200, approximately $200 a month, give them an extra $200 a month. But that would be the economic effects of it. And hopefully they'd go out and spend it and keep the economy going. Right, so these are the payroll taxes, and they're paying 36 in Medicare and 155 in Social Security, and that's current. Over in this column here, we have year to date. So what has been their total that they've paid, because we're in the month of November now in this pay stub. So up through 11 months, 10 months, since it's the beginning of November. Medicare, they've paid $1,600. Social Security, they've paid about $7,000. Okay. But those aren't the only taxes. We also have federal tax here. This is going to be withholding for income taxes. Right? Essentially, if you sign up for withholding and there's a default withholding, you can choose to withhold more, you can choose to withhold less. But the withholding for income taxes, they're going to take money out of your paycheck, and so money comes out of paycheck, to be used to meet your tax obligation. Right? So in the example that was up on Google Classroom yesterday, I had you calculate Elon's tax obligation. His tax obligation, I don't remember the exact figure. It was around $90,000 or so. So this federal tax withholding would be used against that, which means, let's say it was $90,000 for this. Well, let's say this guy had $15,000. Okay, let's say his tax obligation was $15,000, right? If he withheld less than recommended, he would have a tax bill in April. Okay, but if he withheld more, which he can do, than recommended, he would get a tax refund in April. And this is where most people think about it all wrong, right? Because most people want to get a large refund. If you ask the average American, they want a large refund. What that means is that those people have given the government a an interest-free loan for a year, or at least a year, or at least a couple months, and then the government just pays you back the money that you essentially overpaid on your taxes, and so they're going to pay you back the amount that you overpaid. You're not getting anything more. You're getting back what you should have kept all along. So withholding less than recommended, let's say they only withheld 13,000, right? If they held 13,000 and here we are at 15, they would have a tax bill of $2,000. But if they withheld 17,000 and the tax bill is still 15, they get a tax refund plus 2,000. That just means $2,000 they could have used during the year. They're going to have to wait till April to get back. So the goal when you're filling out your taxes is to minimize like your bill and your refund. You want a refund as close to zero as you can. Okay, or a bill as close to zero as you can. You don't want to give them more than you're required, and unless you're good at saving money, you don't want to under withhold, because then come April, $2,000 bill that can wreck your budget. So you want to get as close to zero as you can. All right, so let's go through the rest of this. Okay, so here we have, they've withheld about $559 from this current pay period, and in total year to date, they've withheld here $25,000, and the withholding is based on an estimation, right? So his taxes are going to be federal income taxes are going to be around $25,000 here. Okay. But this person's probably going to get a refund. And the reason he's probably going to get a refund is because the next category here is CASTX. That stands for California State Taxes, because California has a state income tax. And so this person living in California, they need to pay those California state income tax. For our purposes, we live in Texas. And Texas has no state income tax. Now, I just said that this person is probably going to get a refund because he pays California state taxes. Part of the tax code allows someone to deduct their state taxes from their federal taxes, and we'll show that. So he'll be able to deduct $8,000, but we'll take a look at that later on when we start filling out the forms. Right? Okay. So let's get back to Texas. Texas has no state income tax. So if I change this to TX, let's say this person was living in Texas, this number right here would be 0, and this 8,000 would be 0, right? Texas does make up for it by having a relatively high property tax. And a relatively high sales tax. Right? So sales tax is going to be 8.25%, or you can also write it out 0.0825. And out of that 8.25%, 6% goes to the state government, and 2.25 goes local. Right? But we do have 8.25% in sales tax in Texas. Okay. So moving on, the thing underneath state income tax is SDI. I'm not 100% sure what this SDI is referring to. If I had to take a guess, based on things that are also in our pay stubs, I would say it is health insurance. So if your employer provides health insurance, oftentimes you share in that cost. You're going to pay some of the premium. And so this is going to be your health insurance premium. And so he pays $25 per pay period, total of $1,100 a year, thereabout. That's not bad. That's a pretty good premium level. Okay, if your employer does not provide health insurance, you won't see this on here. And you should probably buy health insurance on the open market, and that's going to be really expensive right now, but that's a topic for another day. Okay, going down, this last row here just kind of totals everything up. We have the year-to-date gross, year-to-date deductions, and then year-to-date net pay. So gross minus deductions equals net pay. And this just takes a look at the current paycheck. So what will be deposited in his checking account each week? About $1,540 will be deposited. All right, let's move on down. If I'm going too fast, just slow down the video. Okay, so we're taking a look at another pay stub. This guy, so we're only going to look at the differences here because a lot of it's the same. But this individual works and lives in Texas. You can guess what city he lives in, right? But works and lives in Texas, which means when you see that, and for our purposes, our scenario will work and live in Texas, we see a state tax here. Uh-oh, state tax. But wait, 0 and 0, because Texas has no state income tax. All right. Now, if we have no state income tax, you may ask, why even include this line here? Well, this person works for Xerox, and Xerox, a fairly large company. They have businesses in multiple states. Some states have income tax, some don't. And so they're doing this payroll, and they're just going to create the form for the payroll that applies to all 50 states. If they have a state tax, they'll put the tax rate there, or the amount of taxes there, and they'll apply it for businesses being paid in that, or for people being paid in that state. So for Texas, they have the column there, or the category there, but they put 0 in, and it just pushes out zeros, right? So that's why they would most likely have it there. Okay, so let's take a look at anything else. This person is getting paid every 2 weeks, it seems like. It's not the beginning or in middle of the month, right? December 11th through December 24th. So most likely it's going to be every 2 weeks. And he's getting paid on Christmas. Good for them. Okay. The other big thing, okay, so we have our Medicare, FICA taxes, and our federal withholding. That's all from above. But the other thing is this guy's getting paid hourly, $12 an hour. How many hours did he work? He worked 80. Oh my goodness. But remember, 2 weeks over here. So that's 80 for 2 weeks, which comes out to comes out exactly to 40 hours per week. 40 hours per week, full-time job. Okay, and so $12 an hour, 40 hours a week. This person got paid $960 for 2 weeks. Fairly low, right? But we also have another new category here, overtime. 18. Why the upward in overtime, Bill? Because for overtime, people get paid if they're required to work overtime. They tend to get paid time and a half. All right. So you take the 12. What that means when people say time and a half, you take the hourly wage 12 and multiply it by time, that would be 1.5, which 12 times 1.5 is 18. And so we can see here they got paid, or they were required to work 2 hours overtime, and so they got an additional 36 bucks on that, right? Going on right now, what's going on with the grocery stores? Lots of overtime. So you may see a lot more grocery stores or delivery stores hiring because their current workforce is required to work overtime, and that means they have to pay them time and a half. How do you not pay time and a half? You have more workers that you can pay the regular hourly wage. And businesses want to lower their costs. So that's pretty standard. All right. So let's see. You see here, holiday and vacation. That just means, let's say this individual has 2 weeks vacation. That would be 10 days vacation. Okay. That's equal to 2 weeks. When people say 2 weeks vacation, it's 10 days because a work week is 5, right? So 10 days vacay. Let's say this person does not use all 10 days. Let's say they use only 5 used. Okay, so they have 5 left over. We're at the end of the month, so their chances are they're not going to use that 5. Maybe they would, but let's say they don't. Okay, they don't use the 5 remaining. Depending on the company, 2 things can happen. One, this 5 could roll over to the next year. So next year, they get 15 days. Well, some companies don't really like that because it makes planning harder. And then what do you do if an employee racks up so much vacation time? They just say, hey, see you next month. That puts the business in a little bit of a bind, right? So the other option they do is they say, okay, you have 5 days vacation day. We will pay you for those 5 days. And so if this person had any vacation day that wasn't going to be rolled over, that was going to be paid, that this is where that information would be, and they would get paid something for it. Depends on the company policy, right? Okay, that was just a little extra information so that you're familiar with it. When you start working, you know everything that's going on with your paycheck. Okay, everything else is the same. The next form that we have is a Form W-2. This takes a look at everything that you've been paid and for the year and just summarizes it, right? So we're in 2020. When people fill out their taxes this year, they are filling out their taxes for 2019. So if this was, this would show 2019 down here at the bottom instead of 2014. So I just mark that over, right? So information that is going to be important. Well, employee social security number. One of the things that you'll need to figure out when I give you the tax return is where to locate the social security number. W-2 is a place to locate this number, right? Okay. You're going to have the employer's identification number. That you really don't care about, okay? Employer's name, address, and zip code. So that's all the employer stuff. Again, for filing your personal income tax, you don't really care about that. Oh, one thing I forgot to mention. W-2s. People receive this. You'll receive this about end of January, early February, from all the places that you've worked for for that year. So if you had multiple employers during 2019, you would receive a W-2 from each of those employers, okay? If you only worked for one, you only get one W-2, okay? So here we have employee's first name. This is the other thing you're gonna have to figure out is where, because I'm not gonna go out and directly tell you where they live. You're gonna have to figure that out for yourself in the scenario. And that will be found on their W-2. Okay. The other thing that you really want to be aware of is over here, wages, tips, and compensation, and then federal income tax withheld. So let's take a look at these two things first. Okay, so this individual got paid $48,000 for 2019, and they had $3,100 withheld from their taxes. So that would have been in this category right here. FICA is a separate deal. It's not for federal income taxes. Okay. So $3,100 in federal taxes withheld. Now you see here in 3 and 5, boxes 3 and 5, it has 43 and 43,000. Well, that doesn't mean that this person got paid 48 plus 43 plus 43. No. All that means is that out of the 48,000 they got paid, only $43,000 of it is going to be subject to Social Security taxes. Maybe that extra 5,000 came in a form of income that wasn't subject to it. Okay. And again, here with box 5, $43,000 of the 43 is going to be subject to Medicare taxes right here. Okay, but we really don't care about those for filing federal income tax returns. The ones that we care about, okay, for the information on here that's going to be important is Social Security number, personal information, how much did they get paid, wages, and how much was withheld. Okay, let's just kind of go through the rest. Here they have a retirement plan, so most likely it's a 401k. And when you start working, if your company offers a 401k with matching, employer matching, take it, contribute to it. Employers tend to match, about like 3%. So if you put 3% of your income in the 401k, the employer will take 3% of your income and contribute to the 401k. That is free money. You're essentially getting a 3% bonus for saving money for yourself. Okay, so we want to do that. Don't leave money on the table. Here it says state income tax. Well, we live in Texas, so that's going to be 0. So we don't care about that. All right, let's move on down. This is going to be a blank one. This is going to be the one that I fill out and give to you. It's going to have a fictional person's information all over it. All right. So what sections should we care about? Well, we should care about section A, box A. We also care about box E and F. F is going to, it's here. It's in the same box. And then we care about box 1 and 2. The rest of it, we don't care. For our purposes, we do not care. All right, moving on. So this form is called Form 1098. It is the mortgage interest statement. Remember in class we talked about how sometimes the government uses the tax code to encourage certain behavior or to discourage certain behavior. Well, one of the behaviors that the Congress has said we want to encourage is people getting a mortgage. Because if they get a mortgage, that means they buy a home. And we want to encourage that property building, or the property ownership. So mortgage system, and the way that the government encourages people to get a mortgage is they say, look, okay, so let's kind of take a step back and talk about what a mortgage is. A mortgage is a loan to buy a house, typically to buy a house. And if you don't pay your mortgage, the bank gets the house, right? It's called secured debt. So you don't pay the mortgage, bank gets the house, and they can sell it and recover their money. Okay. So part of paying back this loan is you have to pay back the amount of the loan, which is called principal, plus interest. Interest is, so let me make that clear. Interest is the cost to borrow. Cost to borrow. So you're going to have to pay back that interest. And so the federal government says, look, we will let you deduct, we'll let you take the amount that you paid in interest and subtract that from your taxes, right? So you're not, we're going to kind of help you out here. Okay, so that's the way they encourage it. Now, in 2017, Congress passed a new tax law, and part of that tax law limited the deduction for this to $10,000. What that means that if you paid $12,000 in mortgage interest, sorry, bud, you're only going to be able to deduct 10,000 of it. So that other 2,000, that's on you. But if you paid $7,000 in mortgage interest, you get to deduct all of that, right? So it put a limit on that. And the policy behind it was, why should we? This is to encourage people that maybe wouldn't buy a home, allow them to afford to buy a home. Someone buying a $5 million home on a mortgage, they're going to be the ones that are greater than the $10,000 interest. Well, if they're buying a $5 million home, do they really need the government help to subsidize them to buy a home? And Congress goes, probably not. But for the lower income people, middle income, middle class, buying $150,000, $200,000, $300,000 homes, depending on where you live in this country, that's enough. We'll just cap it at 10,000. Okay. All right. So let's talk about what information is going to be in here. Okay. So this first box says lender's recipient or lender's name. So this is going to be the bank info, right? You take a mortgage, you take the mortgage from the bank that loaned you the money, their info is going to be right here. Okay. Lender's tax ID number. That's like the bank's social security number. It's a tax ID number. From the average American, we use our social security numbers for our tax IDs. For businesses, they have a specific number, right? So some number is going to be here. Okay, and it says payer or borrower's tax ID number. This is essentially going to be the person's social security number, right? For most people that have social security, that's going to be the number there, right? Borrower's name, well, let's just go John Doe. Okay, their address right here. So out of this information, the stuff that you want to pay attention to, if you didn't get the social security number from the W-2, you can get it from here as well, right? Street information and that. Okay, then, so everything highlighted you need to pay attention to. Then you're gonna have the mortgage interest receipt, okay? So let's say this person paid $9,000 in interest, on their house. Will they get to deduct all of that? According to 2017, yes. Check, right? Because 9,000 is less than 10,000. Okay. Outstanding mortgage principal. This is going to be something that, so the mortgage principal is what you originally borrowed. So let's say this person borrowed $250,000. They put the date here of when they borrowed it, but it's been a long time, and they've paid down $50,000 of it. Okay, so outstanding mortgage principal is going to be $200,000. We're not going to worry about this one or these boxes here, right? Don't need to worry about that for the purposes here. So what do you need to pay attention to over on this side? You want to pay attention to the mortgage interest. That's it. Don't pay attention to the outstanding principal. Tax purposes, we don't need to know that, or the origination date. That's going to be information there. You can just ignore it. I'm still going to put it there, but you need to recognize which you're going to ignore and what you're going to focus on. All right, moving on. We have other sources of income here. 1099. Okay, Form 1099 DIV. The DIV stands for dividends and distributions. So let's say you've saved up money and you want to buy stock in a company. When you put that money into an investment bank and you use that investment bank to buy stock in a company, you are buying ownership of that company. Now that company that you now partly own, like let's say you bought Coca-Cola, right? You own Coca-Cola stock, which means you are a part owner to Coca-Cola. They make profits. They may decide, I'm going to share some of that profits with all of my owners. So they're going to pay out a dividend, right? This is shared profits. Well, you have to pay tax on that dividend because that tax code, that big old book that was in my room, that's considered income. And so you have to pay tax on all sources of income. So dividends count as income. You got to pay tax on it. Okay. Payer's name. This is going to be the investment bank that you have your account with. So let's say it's Fidelity. Fidelity Investment Bank. All right, so you have your money in there and you bought stock and it's in the account in this bank. Well, this information is going to, the bank's information is going to be there. Payer's tax ID number, right? Same as Form 1098, but now we're on the 1099. Recipient's tax ID number, that's going to be the person's social security number. Here's our John Doe. Address, city and town. Okay. Then for the purposes of this, we're going to focus on total ordinary dividends. So let's say total ordinary dividends from everything in this account was $3,000. It's a pretty good year. Okay. Well, I guess it depends on how much money they have in that account. But $3,000 of total ordinary dividends, that's going to go to, that's $3,000 additional income they have to pay taxes on. Okay. Qualified dividends, this gets a different tax treatment. We're not going to worry about that. So for the purposes of our project, we're going to say they have $0 in qualified dividends. Capital gain distribution, again, we're going to go 0 on that for our purposes. We're also not going to pay attention to this. Oh, oops, no, we want box 4. This account, this box, this box, or this box, this box, this box. All of those we don't care about. Let's go back to box 4. So depending on your account and how much ordinary dividends, you may choose to withhold money for taxes because you have to pay taxes on it. You know you have to pay taxes. So let's go ahead and start sending some money to the government so they can put that toward my tax bill. Okay. So there may be some number here. Let's just say they chose to withhold. I make them withhold $500. Okay. So on this form, the important information that you want to recognize: recipient's tax ID number, Social Security, right? And the name, address. Then over here, total ordinary dividends and income tax withheld. That's the important information that you're going to want to identify. Everything else you can ignore. I'm going to fill it out. You're just going to ignore it. Okay. Again, it's about recognizing what is the information that's relevant and what information is irrelevant. Okay. All right. And let's go to the last one. This is the last one. Yay. We have Form 1099, another 1099, but it's INT. INT stands for interest income. When you have your savings accounts or checking accounts, some checking accounts, but mainly savings accounts, you loan the money to the bank. That's what you do when you put your money in a savings account. And in turn, the bank takes that money and they loan it out to other people. Well, the other people pay it back and they pay interest. And so the bank shares that interest that they receive with you, since you're the one that loaned it to the bank. So they're going to provide you interest income, and you're going to have to pay tax on that interest. Okay. So payer's name, this is going to be the bank. So let's just say Chase, savings account at Chase Bank. And we're going to have their information there. Tax ID number, it goes Chase again, some number. This is going to be our social security number, just like it was before. Recipient's name, let's go John's wife, Jane Doe. Okay, address and all that. Okay, payer's RTN, we're not going to worry about that, don't worry. So now here we have interest income. And let's say for the purposes, they had $400 of interest income. It's a pretty good amount in savings account. Early withdrawal penalty, we don't care. We're not going to worry about this. Or box 5, box 6, box 7, box 9, box 8, 10, 11, 12, 13, or anything down here. Because state tax withheld, we're in Texas. No. All right. Again, federal income tax withheld. Now, they give you this option to withhold taxes on your, typically people don't withhold it because the amounts of interest income tends to be relatively low. So the taxes on it are going to be, if anything, relatively low. So I'm going to create this, our scenarios are going to be realistic scenarios. And so this is going to be 0 right here, right? So what information do you need to pull from here? Well, here's our social security number, right? Go through that again. Interest income, yes. And, just pay attention to this. It's probably going to be 0. It will be 0, but you still want to identify that. All right. That covers today's. If you have any questions, feel free to comment or rewatch this video as much as you want. And let me know if you have any trouble viewing it. Well, I guess you can't if you hear this message, you've been able to view it. So never mind on that. All right, guys, I look forward to seeing y'all and answering any questions y'all have with y'all tomorrow. Our meeting is Wednesday at 3 p.m. Okay, it's on Zoom. So post any questions. I'll get back to you as soon as I can. Have a great day.